All right. Should we get started? I know some of you got here like really, really early. I got here at 6. I had to go to a call upstairs and the room was already filling up. So thanks everybody for your patience. I'm being told this is the most highly attended event, not only in recent memory here, but maybe of all time, including the opening. We have overflow rooms. So by the way, count yourselves lucky to actually be here right now to hear. I think that means Steve knows what he's talking about, but I guess we'll find out in a couple minutes. So good evening, everyone. I'm Blair Jacobson. I'm the co-president of Aries Management. I'm actually still getting used to saying that as of last week. And again, I want to thank all of you for coming this evening. I'm a very, very proud and engaged alumnus of the school. I was there from 1997 to 1999. I currently serve on the council of the business school, which is basically the board entity. I chair the European Global Leadership group. I'm on Steve's private equity council. I do a lot. Again, it's just been such a great experience for me and so impactful on my career. So it's my pleasure to welcome you to our London campus. Not sure if many of you have been here before, but it's a pretty spectacular place. I don't know if any of you remember the older one. It was a little bit cramped in the middle of law firm offices, but this is a real statement of the school and what we're doing internationally. So this is the Rothman campus, home primarily to the executive MBA courses. Actually, the executive MBA course in Europe is 30 years old. It's pretty amazing just how long Chicago and Booth have been active internationally. And we've been doing this in London for 20 years. And ironically, my co-managing partner works actually an alumnus of this program as well. So again, it's a really, really great thing. It's obviously also a regional hub for alumni who are here. Obviously, state-of-the-art facilities. Hopefully, you guys can get on the Wi-Fi tonight. But by the way, if you want to rent this great space out, it is totally available. Use it for meetings and conferences. Actually, Andrew Bailey was just here yesterday, the chair of the Board of Governors of the Bank of England. So again, it does get a lot of use, but we can always use it a bit more. So as many of you know, Chicago itself as a university is known for having really, really big brains at the school. That includes the professors, the students, the researchers, et cetera. I don't know if any of you guys can guess, but there are actually 101 Nobel laureates affiliated with the university. And maybe on your way upstairs when we have our little reception after this, you can go up the stairway and see all the names. And maybe some of you were even taught by some of these people like I was. The school, again, is global. Chicago, London, Hong Kong, and it's quite well known for its amazing faculty. And that kind of brings us to the topic of this evening. You're all here to see Steve Kaplan, an unbelievable professor, but he's currently serving as the Rothman faculty in residence here in London. Again, what the school does is they bring really fantastic professors from Chicago to spend time in London. Again, you get the benefit of that tonight. So to the main event, I will tell you, Elizabeth, the executive director, literally gave me like 5 pages of speaking points on Steve. That just shows what an impressive guy he is. He's been teaching at the school for something like 36 years. I'm not going to go over all those points, Elizabeth, so don't worry. But I've picked out a couple of the really good ones, some of which are sort of tongue twisters. So Steve Kaplan is the Neubauer Family Distinguished Service Professor of Entrepreneurship and Finance at Chicago Booth. He's also the Kessenich EP Faculty Director of the University of Chicago's Polsky Center. Now, here's a really, really cool factoid. So in 1996, actually just right before I got to Chicago Business School, Professor Kaplan co-founded the entrepreneurship program. With his students, he created this really cool business competition plan called the New Venture Challenge. Again, maybe some of you, I think I like judged it once. Maybe some of you even did it. But if you did it, you maybe did really well, because one of the most amazing statistics is that the companies that have done it, there are over 800 companies. They've raised about $1 billion in total capital. And that in and of itself is unbelievable. However, that has turned into something like 8 billion of value from those companies that won, again, the New Venture Challenge. Again, an 8x, unbelievable. We should all be that good investors in our career. I'm a fixed income guy, by the way. We don't even come anything close to that. So it's super impressive. But Professor Kaplan, his courses, all of you know, it's like sold out immediately. It's really hard to get into. He's one of the most popular professors in this business school. I sort of count myself a proud grad of his classwork. And again, consistently named one of the top business school professors in the entire country. Two quotes that really resonate with me. Fortune magazine called Professor Kaplan probably the foremost private equity scholar in the galaxy. And that's a really, now they're talking about going to Mars. This is like a really high bar. And Professor Kaplan's obviously right up there. And JP Morgan in a research report called him the patron saint of private equity research, which again, I think really encapsulates what he's done and again, what he'll talk about this evening. And again, private equity, as we all know, touches so much of the global economy. All the research that Professor Kaplan does, his teachings have never been more important or relevant. And I would say, personally, I'm really delighted to introduce someone who's not only been so influential on me personally and professionally, but also the asset class where I think many of us have decided to spend our careers. So with that, I would like you to help me in welcoming Professor Steve Kaplan.
Great. Well, thank you, Blair, and thank all of you for coming, and some of you coming early. It's very impressive. I have, as Blair said, I've been here for 36 years, and that's a long time. And like the only, I shouldn't say the only, but the best thing about getting older is that some of your former students get successful. And some of you are here, so please afterwards come up and talk to me. I've already talked to a few of you, but we're going to go upstairs, and I'll look forward to hearing what some of you are up to. I do want to say that Blair was just last week was named the co-president of Aries, which is a huge job and a hugely positive thing. So congratulations to Blair. Okay, so let's see. What am I going to talk about? I'm going to talk about private equity, and I'll talk about past, present, and future. I'm going to talk about, from this will be somewhat researchy, what buyouts do at the company level and at the fund level. And when I talk about private equity, I'm really talking about buyouts here. Venture capital is another form of private equity that's different. Then I'll talk a little bit about why private equity and private capital in general have grown so much. And then I'll talk a little bit about what I think will happen in the future. For those of you who are interested, I wrote a book with Paul Gompers, who was once at Booth, now at HBS, and it sort of encapsulates a lot of this. So if you're interested, feel free to buy the book. Okay, so private equity and private capital has grown a lot. This is just, over 10 years from 4 trillion to 14.5 trillion. You can go back to 2010, it's like 3 trillion. It's supposed to grow to 19 trillion. If you go back to when I started teaching this, was probably less than 1 trillion. And so private equity has really grown over time in the way that Blair has said. And this is another view of it. This is actually a long-term view. This is buyout funds in the United States. This is each year how much capital is committed. And you can see that back in the 80s, it was very small, and that it's grown to the last several years like $400 billion a year. And it came down last year. It was only $300 billion. So, but you can see the trend is strongly up. Now, it's a little misleading because it's absolute dollars. And the way I like to look at the industry is a fraction of the stock market, because that gives you a sense of what fraction of the economy private equity is. And this is the picture where you divide by the value of the US stock market. And you can see there that it's still up for the most part, but with a lot of annual volatility. 2007 is actually the peak year. It was like over 1% of the stock market got committed. And last year was actually down a bit, was sort of below, sort of about 0.5%. So you can see it's gone up. It's a bigger fraction of the economy over time, but it's not quite the same as the absolute numbers. Now, what does this mean in terms of how much of the economy it is? And these are US numbers. The European numbers are, I think, similar, particularly on the buyout side. So the US numbers I have a little bit better, so I can go through. So what this says, basically, over a 5-year period, buyout funds will raise about 4% of the stock market. And since their investments are usually 5 years, maybe a little bit more now, you can figure that they've got 4 or 5% of the stock market invested at any one time. Figure they're leveraged 1-to-1, so that gets you to 8 to 10% of the stock market. They also make some investments that are not in the private equity funds themselves, and you can pretty easily get to private equity funds having more than 10% of the stock market, which means more than 10% of the economy. So the reason that private equity has gotten so prominent is because there's a lot of money there and a lot of people doing it. So that's what you've got. And so private equity is controversial. There's lots of, you read about it in the press. And here are a few recent books about private equity. Gretchen Morgenson, these are the plunderers. And another book with plunder. So this is kind of a negative view that you will sometimes or often get from the popular press. And the question is that the truth? So what I'm going to talk about here is basically what the results are of private equity research. So there's been a lot of research done since I started doing it in the 80s. And what I can tell you is when you look at a large sample of companies and you kind of take the universe of deals, what you find is that private equity funded companies get more productive. You can look at productivity improvements, you can look at operating margins, whatever you look at, virtually every paper that has a big sample finds a positive result. And the best paper out there are 2 papers by Steve Davis, who was at Chicago, and Josh Lerner, who's at HBS. And they look at a very large sample of US buyouts, and they basically find they get more productive. There are other papers, I wrote one of them, finds increase in operating margins. You have some papers that look at European buyouts, they find the same thing. Look at UK buyouts, find the same thing. French buyouts, find the same thing. So it's basically every paper that looks at a broad sample finds productivity improvements. There are a couple papers that didn't find them for public to privates, but then this other paper by Davis and Lerner looked at a larger sample and actually found the positive results. So bottom line, more productive companies and operating improvements. So now the next question is, what about employment? So you sometimes read, in the plunderer books, say this, the buyout firms go in and they just fire people, they gut the companies, and they leave a shell. And of course, going backward, these results say that's not true, that on average they're more productive. But even on the employment side, you look at employment, and in existing operations, it goes down about 4% relative to other companies, which is, some decline, but it's not like cutting the company and firing everybody. And then when you stick in acquisitions and new investments, employment is down by about 1.5% relative to other companies. So it's kind of like employment, there's maybe a little bit going on, but not a ton, and not the real negatives that people talk about. Now, what's interesting is if you differentiate between deals where you buy a private company and deals where you buy a public company, the private to privates actually increase employment relative to other companies, and the public to privates decrease employment. So it's kind of like the private to privates, they're growing them, and the public to privates, they're the ones where maybe they're making them more efficient. But the comparison there, since public to privates are more like acquisitions, the right comparison might be an acquisition. And they're not clear, usually acquisitions, there are more jobs lost. So the bottom line is there is, on average, employment is down a little bit, and it's consistent with these companies being more productive. But there's a difference between the public to privates and the private to privates. So that's employment. And then, over time, a lot of people have written papers that are on non-financial characteristics. And there are a lot of them. You can see I've got a bunch of them there. Most of them are positive. So there's a paper that finds that private equity firms increase their products in geographical expansion. They don't raise prices as much. There's a fun paper that looks at private equity investments in airports, and it finds that the airports become more efficient, that there are more on-time flights, and there's less lost baggage. There's another paper that finds that for restaurants, private equity-backed restaurants have fewer health violations, so bathrooms are cleaner. So there's a whole lot of papers that find sort of positive results non-financially on top of the positive results financially. So that's good. It's not all good. There are a couple of papers that find results that are mixed, in the sense that for-profit education is the one on top there. They find that the private equity investments in for-profit education are profitable, meaning they make the companies more profitable, but they also encourage people to take loans that they then default on. So it has sort of a social negative. So there are a few papers that find, again, positive on the financial side, maybe not on the societal side. There are a lot more papers that find sort of just purely positive. And so, the bottom line is it's really, a positive story, that if you look at what private equity does, they make companies more productive on average. It's generally positive on non-financial aspects, but not always. And, that's, not surprising. So that's the company level. What about at the fund level? So we know that the companies do better, so they should make money before fees. The question is, do they make money after fees? And actually, that's not what's coming next. What's coming next is explaining where this value comes from. And then I'm going to tell you whether you make money at the fund level. So they create value, they make the companies better. Where does that come from? So it comes from three things. First thing is financial engineering. And financial engineering is basically, you give more equity to managers, they're incentivized, and you also put debt on the company, so you have a little bit of a stick to encourage you to pay off the debt and make money. The second thing is governance engineering, and governance engineering is basically the private equity firms control the boards, and the boards are very active in looking after the company. And then the last thing is what I call operational engineering, which is where certainly in the United States and increasingly in Europe, the buyout funds are organized around industries. And when they make an investment, given their industry knowledge and industry expertise, they make an investment with the idea that they're going to make the company better. And that's something they do at the time they make the investment. And that really has increased over time from sort of the start of the industry in the 80s, 90s to today, where it's an integral part of most firms. So this just gives you a sense historically of a little bit how it's less financial engineering and more operational engineering. So this is debt to enterprise value. It's basically the fraction of the capital structure that's debt. And what's stunning is in the 80s, these were like 90% debt. So these are the days when, it was crazy and everybody said it was all leverage. If you look over time, it's gone down to the point where today it's like 50%. So these are leverage, but they're not like highly leveraged like they were in the 80s and 90s. And this is another picture. This is interest coverage. And again, this is over time. So this is EBITDA at the time you do the deal divided by the interest that you're requiring. And you can see in the 80s and the 90s, that ratio is less than 2. So they're very, very tight. And really since the 2000s, the deals are done at, 2.5, 3 times typically. So there's much more of a cushion than again that you would read, that they're not like these super tightly leveraged things like they were in the 80s. Okay, so now let me tell you a little bit about what the buyout firms say they do and what we think they do. And this is based on 2 surveys that I did with Paul and Vladimir. And we surveyed actually a decent fraction of the AUM that is out there in private equity. So first thing we asked is, what do you look at when you make an investment? And the 3 things that are most important are the business model, the management team, and third, their ability to add value. So when they make an investment, they're thinking about all 3, but ability to add value is important. Then we ask them, where does their value come from? And the value, the number one thing that they said they looked for was growing the business. So again, the view that they go in and they just cut and cut and cut, that was way behind. Cost cutting was way behind, and multiple arbitrage and leverage were also way behind. The thing that they're focusing on is growth, and that makes sense because if you buy a company to make money, you have to sell it. And in order to sell it, somebody is more likely to pay you something, the business is growing, than if it's contracting. And so it's a very, very much a focus on growth. So, and then last thing I'll tell you about this is, again, you read a lot that they cut costs, they cut the companies. It's negative. I was a judge for a number of years for a kind of deal of the year publication with Private Equity International, where they would get, these are good deals, so it's selected, and you'd read about the deals and then you'd pick who you thought was the deal of the year. And what you found in these deals, which were very successful, like 50% annualized returns, is they had a new CEO, they upgraded the team, they had a new strategy, they upgraded technology, they had a new sales approach, new products. Those are all sort of about growth and making the company better. Improved efficiency is there, and improved efficiency is, that's probably cost cutting and acquisitions. But you can see that a lot of the things they're doing in their successful deals are making the company better and growing it. So again, it's just, I'm being a little biased here and telling a positive story because you read so often the negative story. And when you read these books, they always point out the bad deals. And What they don't point out are the good deals. So two of the deals in those deal of the year additions that I mentioned were actually private equity deals where they bought a chemistry or chemical supplier and they transformed them into suppliers for the mRNA vaccine. So two of the very big suppliers for your COVID vaccine were private equity deals. Couple other deals that are good. Let's see, how many of you golf? You know TaylorMade. So TaylorMade, big golf company. They were taken over. They were owned by Adidas. They were losing $80 million a year. And KPS turned them around to the point where they're making almost 200 million a year in EBITDA. Very successful deal. And was private equity driven. So I'll go through that. So the bottom line is the private equity firms make the companies more productive. There are reasons why that happens. It's not every deal. There are winners and there are losers, but when you add up the winners and losers, the average is winners. So now the question is, do you make money at the fund level? And this is something where the data, were really just not available until about 20 years ago. And since then, the data have gotten a lot better. And I'll tell you about some of the data. And the reason why, you don't necessarily make money as an investor in a fund versus the private equity firms at the company level is that there are fees, and the fees are not small. And you also have to buy the company. And when you buy the company, you usually have to pay a premium. And so some of the value can go to the seller. And so, the question is what happens net of fees? And I should say that, in a competitive market, net of fees should be close to zero because there's competition and the people who get the gains are going to be the sellers and the private equity firms. But let's see what we find. So I'm going to use data. The data I'm going to show you are from Burgess MSCI. It's probably the best data out there because it comes from the limited partners or the institutional investors, and it's not selected. So it's pretty much universe. And I've written, a few papers on this, and I'll tell you about them. So first of all, the industry uses annualized IRR, and that's sort of your annualized return. And they also use multiple of invested capital, which is MOIC, which is just sort of how much cash you get out versus how much cash you get in. And those are kind of been the historical things that the industry uses. And as I said, I'm using Burgess MSCI data. All the data providers actually get you similar results on the buyout side. And I should add, there's a new data set that actually covers family offices. It's called ADAPAR. So you get a different set of limited partners and a different set of funds. And the results there are also the same. So these results are almost certainly correct. So these are IRRs by fund. And the red is median, the black is average. And each dot there is what you would have earned if you'd bought every fund that came out in a particular year. So you can see the funds raised since the financial crisis have been, somewhere between 15 to 20% a year. All this is net of fees. And if you want to look at cash on cash, this is, again, it's like usually between 1.5 and 2 times your money over the life of the fund. So you put in $1, you get back $1.5 to $2, depending on the year the fund was raised. So let's see. This is good. This was US, and now I'm showing you US versus Europe. And the US was definitely better, 2008 to 2010. It's kind of been similar for funds from 2013 to 2020. And actually in the 90s, it was a little bit better in Europe. So a little bit more of a range in Europe, but sort of that 1.5 to 2 times is pretty consistent. Okay, so what's the problem with MOIC and IRR? Yeah, you have no idea whether that's any good because you have nothing to compare it to. You know, is 1.5 or 2 times your money good? Really depends on what else you could have done with it. And so I got lucky. I kind of wrote the first paper that had any data to do this on with Antoinette Shore, who was a PhD student of mine and is now she's now the editor of the Journal of Finance and is a very senior professor at MIT. It's another student who's done very well. And what we did was we said very simply, let's compare what you would get investing in private equity to what you would get investing at exactly the same time, same amount in the public markets. So I'm using the S&P 500 here. I can use a European index for European funds, but it's basically making an apples to apples comparison, you know, to see how you did. So we did that. And basically what this tells you is if you have an index here, it's called the public market equivalent, and it's bigger than 1, it means that you got more investing in private equity than you got if you'd put the money in the S&P 500. What's good about this is it controls for the market. It's also IRR is very sensitive to how you sequence your investments. Here, it really isn't sensitive to how you sequence them. So now 2 questions. Question number 1, and let's do post, you know, the great financial crisis. So it's 2009 to 2020. How have buyout funds in the US done versus the S&P 500? So how many of you think the buyout funds have done better? How many of you think they've done the same? And how many of you think they've done worse? Oh my God, it's like 40, 20, 40, right? You have no idea. Excellent. That's excellent. That's good. Okay, that's 1. You'll see the answer soon. Number 2, how have European buyout funds of the same vintages done relative to the European index? So how many of you think better? How many of you think the same? And how many of you think worse? So again, this is like they're more bullish about Europe because you're here, huh? So that was like sort of, as far as I could say, 60, 20, 20. Okay, well let's see. Here we go. This is the US. So this is, and again, the red is median, the black is average. And you can see where that 1 is. This is like unbelievable, right? This shouldn't have happened, right? I told you in competitive markets, it ought to go to 1 or it'll go to, you know, and it's actually, I think in 27 out of 30 years, 28 out of 30 years, it's above 1. So if you want to know the 1 reason why more money has gone into private equity, it's all you need to know, right? If you're an LP or a institutional investor or anybody, it was actually a good thing to put money into private equity. So that's the US. Now Europe. Oh no, it's not Europe. That's annualized. So annualized is like 3 or 4% a year. Okay, so it's real money. Now here comes Europe. There's Europe. Europe, it is the same. This is the black is the US and the red is Europe relative to the European index. So what you can see there, the picture's actually pretty much the same, that in Europe, really actually all but 1 vintage, the European funds have beaten the European index. Now, that's the good news. You know what the bad news is? I'm comparing Europe to the European index. What happens if I compare it to the S&P 500? Ooh, okay, there we go. That's the S&P 500, because the European index has underperformed the S&P 500 over the last 10 or 15 years, and so you can see that brings Europe down relative to the U.S. So if you're a U.S. investor, you did better in the U.S. funds than the European funds. Same thing if you're a European investor, but you did better being in private equity than being in the European stock market. Of course, the question is going forward, the S&P 500, I don't know if it's likely to have such great performance relative to Europe going forward. So we'll see. But the nice result there is that the buyout funds in both geographies have outperformed the public market. And again, that shouldn't happen going forward if there's competition, but it's like unbelievable that it happened for so long. And we'll see whether it happens going forward. Okay, so that's performance. Buyouts outperform public markets. And there's always a question about whether they're riskier or not. And in fact, I got an email today from somebody saying, aren't buyout funds just a leveraged investment in the stock market? And so they're not doing very much. And it turns out, when you look at the risk of buyout funds, and these are papers where they look at the cash flows. So they're not, it doesn't have to do with how things are reported. These are like what the cash flows are doing, that the risk is sort of like owning the stock market. It's like a beta of 1. So it doesn't behave at the fund level, doesn't behave like a leveraged investment in the S&P 500 or the European market. It behaves sort of like an investment in just the market overall. So it's another way of saying risk doesn't seem to explain this. If you control for risk, you still get the same sort of positive results, that 3 to 4% a year that I mentioned. Other indices, in the US, you could use the Russell 2000, which is small cap, which is probably closer to what the buyout firms are investing in. And it's even stronger. It's like, way above 1 post GFC, because the small cap index in the US has underperformed the S&P 500 over the last 15 years or so. So valuation's accurate. I'm going to skip through that. Whoops. More or less, there's some of you may have heard Ludo Philippou, who is a professor at Oxford, who says that buyout funds haven't outperformed, and he's gotten a fair amount of press on that. Whereas I'm going the wrong way. In the FT, was in the FT again. He sort of gets quoted every so often. I'm not going to go through this because of time, other than say he's wrong. And he's wrong. He's wrong for 2 reasons. Number one, he compares apples to oranges. Like in the paper that gets a lot of citations, he didn't look at buyouts relative to the public markets. He's stuck in real estate. He's stuck in infrastructure. He's stuck in energy. And those move differently and actually had lower returns. And the right comparison is not the S&P 500. The right comparison for real estate is some real estate index. Energy, it's some energy index. So when you do the comparison properly, you get my result, not his. The other thing that he did is he picked a time period that was like the worst time period to pick. It was 2006 to 2015. If you use 2000 to 2015, or if you used post GFC 2009 to 2015, you got my result, not his, even when you included the wrong assets. And then when you included the right assets, it went even up even more. So that's all I'll say. I'm right, he's wrong. Okay. So I'm going to skip persistence. Let me get, because I want to take questions. So summary at the fund level is basically the performance has been very good. It's been unusually good. And it's, it's hard to imagine it can continue. But I did say in 1998, I gave a talk and I said, there's no way this positive alpha can continue. It's kind of wrong for 20 years. Then I said it again in 2007. So now I just say someday, but I have no idea when. So, and we'll see. And I should also add, which I mentioned, real estate, natural resources, infrastructure, relative to the S&P 500, they're lower, they have different risks. So it's, again, you want to do apples to apples. Okay, so why has private equity grown so much? I think I showed you it's the returns. I think the other thing that actually is in some of the papers is that the returns don't move one for one with the stock market so that you get some diversification. And you can actually see that the funds that were raised in 06 to 08, actually their performance equaled the stock market. And you would have thought with the leverage, they would have underperformed. And then the funds that were raised in 2020 and 21 are probably not going to do as well as the S&P 500 because of the tech. So the risk factors in the funds are different. And as I said, overall, it's about the same as the stock market, but it's not 100% correlated, so you get some diversification benefit. Third, regulation. It's very unpleasant to be a public company executive because of all kinds of regulation and activists and whatever. So private equity is kind of attractive in that sense to executives because you can operate without that scrutiny and heavy regulation. And the private equity firms are helping you because they have some operating expertise and operating help. And this is true in the US. I think it's really true in Europe because in Europe, the public company CEOs aren't paid very well. I mean, it's like something where I know in the UK, there are institutional investors who the CEO gets a raise and they start yelling, this shouldn't happen. And they're still way underpaid relative to the US CEOs. And so when I hear that, I spoke at a conference, this is like 4 or 5 years ago, and I heard them saying this and I said, private equity loves you. Because I think the best CEOs or talented CEOs are going to go to private equity because A, less regulation, B, they get help, and C, they get paid more. So I think that's happened. Private credit as well, which it's what Blair does. That's also grown a lot. Also, regulation has helped that. That's the post GFC regulation. Really told banks, we don't want you to hold these leveraged loans. And so the banks have been getting out of that business, and private equity firms have opened private credit to do that. Real estate, natural resources, infrastructure. Again, I have less to say about that. This is more about buyouts. So the future, what's going to happen? So, should you invest in it if you're thinking of investing in it? And what's going to happen? So now I have a 50% chance of being right. Right. Looking backwards, I'm pretty good. Going forward, we'll see. So what's going to happen? I think I already mentioned, you saw that amazing performance record. 2020 and 21 vintages are going to they're going to have a hard time beating the S&P 500 for US funds because they did deals in 2021 in particular at high values and low interest rates. And the values have come down some and interest rates have gone up. And at the same time, the S&P 500, has done spectacularly well. So I'm guessing you will have a vintage or two that underperform the S&P 500. Now, Europe, that may not be the case because in Europe, they still maybe paid the high prices and had the low interest rates, but the European index is not, hasn't performed as well as the S&P 500. So I think you're going to see some poor performance. And of course, the press will write about that and say private equity is terrible. probably makes it a good place to go when they start writing that. So going forward, what do I think? The buyout firms, when you talk to them, are still trying to underwrite deals at 20% IRRs, that's gross of fees, and they're looking to make 2.5 times their money. And so as long as those are their targets, the risk return, I think, is still pretty good, because even if they don't hit their targets, they've got a lot of cushion once you have a 20% target to deliver something that's attractive. So the risk return on private equity, I still kind of like. You get diversification. I think the risk return is good, and I would still invest. And particularly middle market. Middle market has the advantage they can sell things. The mega funds, it's a little tricky because they're so big now. It's hard for them to exit deals because going public is hard. Selling to a strategic is hard, particularly if there's antitrust, and selling to another private equity firm is hard because you're big. So the megas, I'm less sure of. Middle market, I think, is still a good place. Tailwinds, operational engineering is real. The CEOs, as I said, still like, private equity is attractive to them. The regulation is less onerous for private companies. I think the US, that may change. The regulation is going to come down a little bit, but it's still the case. Private has less. You can make some long-term bets that are harder to do as a public company. And as I said, there's diversification. And private credit, also has tailwinds. Private credit has the problem. There's really a lot of money going there. So their challenge is going to be a lot of money is coming in. So Blair is going to have to fight off his competitors. Why should you be concerned? The fundraising has been substantial. The multiples are still high. Interest rates are still high. And after today's inflation in the US, looks like they might stay there. And exits are still tough for mega funds. And again, there's this headline risk from the press. And I would have said regulatory risk. Regulatory risk in the US is now lower, although the tax risk is still there because they just announced that they want to tax the carried interest more highly. So, regulatory risk is still there. It's probably less in the US than it was. So who's going to win? I think the bottom line in all of this is you still really have to do at least as well as the public markets. And that's something, again, that you've seen. They've done better than public markets for a long time. If they stay at public markets or above, then it remains attractive. Once private equity goes below and particular funds go below, then it becomes trickier. So I think I will stop there. And now we have time for questions if you have any questions. So let's go. Okay, right there. Oh, there we go.
Hi. Did you consider comparing to, given the amount of money that went into tech firms and how well tech has done as an industry in the States over the last 25 years, did you consider comparing to NASDAQ or coming up with a NASDAQ and S&P composite index and then comparing PE to that?
So if you look at PE, the IT percentage has gone up, but I think, I just looked at that today, it's like 25%. So it's still like S&P like. So S&P got a lot of tech, particularly post GFC. So I think what you'd like to do, and I couldn't do there, is sort of take a tech fund like a Thoma Bravo, compare that to a more tech index, take the healthcare, compare to a more healthcare index. So I haven't done that. What I just basically can do is the small cap and the S&P. So it's a good question. I think at the end of the day, you would still get these results, but it's something that's worth doing. Yep.
Hi, Professor Kaplan. It is a great presentation, a lot to take away. If I'm not being too greedy, can I ask 2 questions?
Well, ask one first.
Thank you. So I'm an investment risk analyst, and I oversee both the public and the private market. So I have a question for how much diversification effects if we have both investment in public asset and public equity and private equity in terms of the sectors.
So, I mean, there's a question, I mean, it's a good question that I don't exactly have an answer as to what your allocation should be, right? And it depends on, you'd want to know the industries, and this is sort of the first question too, the industries in the S&P, the industries in private equity, venture would be another category, and then figuring out what your allocations are. And I don't, I'm trying to think, I have not done that. I have co-authors who have done more of that, and I forget, their allocations are not all that different from what you see some of the institutions are to how much goes into public versus private. And it also is probably going to depend on the particular investor, what your risk appetite is. So I'm going to, punt the question, just say it depends, other than you should have a diversified portfolio, and a diversified portfolio, you're going to want to have some private as well as some public. Okay, we're going to go to another. Go ahead. So the question is, PE, and this I just looked at. I'm writing sort of a retrospective paper now. My thesis advisor, who was a big student and proponent of private equity, Mike Jensen, passed away last year, and there's now going to be a memorial volume for him of the Journal of Financial Economics. So I'm writing sort of a retrospective. So some of this will then go into that paper. And if you look at the exits of these deals, it's sort of like 40 or 50% is private equity to private equity. And then there's another like 40% strategic and probably 10, 20% IPOs. The question is, how do you make money, or what are they doing? And the answer is, number one, the returns have been good, whether, for both the sellers and the buyers, because if you've done this a few times, it's in there. And that's, so they're doing something. I would say the mega funds, the returns have been lower the last, 10 years than the middle market funds, which is consistent with they're not maybe doing as much as they would have. I would say third, when you do look at these, they're doing different things. So I wrote a case on Columbus Meats. So this is one of the deals of the year, and it was very nice. It's a former student, Greg Purcell, who did the deal. And Columbus Meats was sort of, they make, charcuterie and things like that. They were in San Francisco, and the first private equity firm bought it from the family and sort of cleaned it up, right? It professionalized it, literally cleaned it up because it's meat. And they had a good outcome. Greg bought it, and what did Greg do? Greg took them national. So they were in the West Coast of the United States, really high quality, and he had contacts at all the big, grocery stores, the Costco's, the Kroger's, whatever. So he took them, and he made a lot, invested. He also, like, their plants were still dirty; they weren't completely cleaned up. He modernized their plants, and he got them national, and then he sold it to a strategic, Hormel Foods, and made 8 times his money. So this was the original investor made 3 times, Greg made 8 times, and then it's a strategic, so no more buyout. So I think, when they do it right, somebody's doing one thing, and then the next buyer is doing something else. It's the hard part is once you get to the megas, what else are you going to do? And that's sort of, I think, the challenge for the mega funds. Okay, why don't we go? There we go.
One of the reasons why PE had superior performance against public markets, it looks like because PE was able to innovate, moving away from financial engineering to operational engineering. What do you believe is going to be the next innovation for PE firms? And also, why didn't they continue combining financial engineering with operational engineering? Thank you.
So that's a really good question. So that's the really tough one right now, because I think initially it was financial engineering and governance engineering, and that was effective. You saw that in the 80s and 90s. But then the problem is, once you know, oh, I should do financial engineering and governance engineering, everybody does it. And then, the price you pay is going to reflect that. So you got to do something on top of it. And so what happened on top of it is the private equity firms invested in operational engineering of different forms, or differentiating themselves in different ways that they didn't really do when I started teaching them. And I tell people, when I started teaching this, and I would bring a GP into class and I would ask him or her, how do you think about your differentiation? They would like look at me like, what are you talking about? And it's like, don't you think about your differentiation when you're doing a deal? And I say, no. And I say, okay. That's when I knew that's when I should have started a private equity firm. Because the people, guy that figured out, the people who did that, I have one student who started one in healthcare who's done spectacularly well. And so people figured that out. Over time, everybody's figured that out. It's now table stakes. And a lot of the firms now have that, and they're competing with each other. So this is also a challenge in how do you, earn an excess return. And, it's a good question. I don't have an answer. I'm hoping some of you will have the answer and tell me, but people who figure it out, those are going to be the next generation. And until then, I think it's again, people are adding value, and the question is how much goes to the buyer versus the seller. Randall? Okay, so the question is, how do I account for the illiquidity? So you get illiquidity in the private equity. If you're in public, you're liquid. And this is kind of, I think, a philosophical question, or maybe a religious question. It really depends. I think there are some people and some investors where you need the liquidity, and then you're going to put some value on it. I don't know what it is, right? Could be 2%, could be 3%. Then there are some people for whom, I don't need the liquidity. So my portfolio that's in private equity and venture, it's for my kids, right? So that, I don't care about the liquidity. All I care about is I'm going to earn a better return. So for that, it's very small. And then there's the, I don't know, the cynical view. There's another view that should be negative, not positive. Why is that? Did any of you sell stocks in 2008? Did any of you sell stocks in March of 2020? I did. And that was really stupid. So it sort of freezes, it freezes you. So you can't do something stupid when there's all this, uncertainty. So then maybe it should be negative. So that's why it's really, it's philosophical or religious, and it's going to vary with the investor. Yep. Uh-huh. Okay, so the question is, the LPs, invest directly. They also co-invest with their GPs. And, will they crowd out the GPs? And the answer is, I don't think so, because for an LP, you have to believe being a GP is actually hard, right? And all the reasons we talked about, they're doing something, they're smart, they've invested in capabilities. The LPs don't have that usually. And the LPs are not paying their talent the same that the GPs are. So if an LP is any good at doing direct, where's the LP going to go? They're going to go to the GP and get paid. And if the LP isn't any good, where's the LP going to go? LP is going to stay. So you have the incentives really matter, the expertise really matters. And so I think that's there's some of the big LPs, the big, sovereign wealth funds and pension funds, but the good ones actually pay their people. And they're more, and even so, a lot of those people go to the GP. So I think there'll be LPs who are smarter, who do some of the co-invest and direct, but they'll always be the GPs, because very few LPs, I think, can do that. Okay. Okay, so question is, fundraising is hard. So is there pressure on the private equity fees? And some of you who've had my class, I do this to you to explain what will happen. There can be a little pressure on the management fee, but the carry, it's very hard to put pressure. And I wouldn't expect, and the reason is, anybody here, most people get paid 2 and 20, right? Or 1.5 and 20. Any of you, would you do a fund at 1 and 10? Anyone do a fund at 1 and 10? Nobody's raising their hand. How come? If you do a fund at 1 and 10, is anybody going to give you money? No, because if you're at 1 and 10, you must be a loser. And so that you have this funny thing that the market clears on quantity, not price. So it's very hard, as long as people are beating the public markets, some of them, that's what you're looking for, and that's what you get paid for. So the carry is very sticky on the way down, as long as there's outperformance. So I see we are out of time. I'm going to take one more question, and then we're going to go. There you go. Okay, so the question is, what's the AI story here? That may be, that's the answer to the question over there, right? What's going to be next? Maybe someone will figure out how to use AI better than other people, and that'll be an advantage, and you'll make money. So I think that's one possibility. I mean, this sort of happened in 1998 with the dot-coms. Everyone's talking, oh, the internet, it's a dot-com. We have to have an internet program. And people are doing the same with AI. And at Booth, what we did not do that. We just did entrepreneurship. And I said, why? It's the internet is business. AI is just business. It's a different tool. Like the internet was a tool, mobile's a tool, AI is a tool. It's going to be ubiquitous, I think, because it's a useful tool. People will incorporate it in their business. The people who do it more quickly and more intelligently will make more money. And that's what happened with the internet, happened with mobile, it'll happen with AI. So I encourage you to figure that out and go implement it. Just tell me first, because I'll invest in it. So very good. That was a great last question. And thank you all so much.
So on behalf of Chicago Booth, I want to thank you all for coming tonight. I'll tell you a funny story. I woke up today and I said to my wife, should I wear a tie today? And she goes, Blair, you know Steve's going to wear a tie. So you have to wear a tie. And I'm really glad that I did. Obviously, great presentation from Steve. Again, give him another round of applause, please.
Thank you.
Good one. And we'll invite everyone for a networking reception upstairs. Have a great evening. Thanks for
Thank you. Good, good. Was that good?
All righty.
Thank you. Thank you.
You smashed it.
What? Good, very good. How are you? Yes. So what are you up to?